So last week, we focused on the Chinese stocks from a bottom-up approach, from their business fundamentals. This week, we're going to go from an higher economic level, right? So macroeconomic view. They are very different strategies, and I would say that many of your institutional funds and portfolio managers do take a macro level portfolio allocation kind of strategy. If you hear words like broadly diversified, macroeconomic regime, risk parity, these are all keywords to know that your portfolio should be created from a macro level, which looks at central banks, interest rates, global debt, bond yields, broad equity valuation, GDP, and all those kind of stuff. So if you have your money in something like that, today probably will help you to give a better perspective of the current situation with the US-China trade war and all this legislative stuff lah. So welcome back. Welcome to another Chills with TFC session. In this series, we have to bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape around the thinker. So in our pursuit of the life we love or managing our finances, well, our guest for today is the CIO of one of the biggest robo-advisor in the region. They are focused on an economic regime, macro-style investing, and you have heard from him a few times. So I'm happy to bring him on again to share with us his thoughts on how he sees China, specifically China-US relations, and China's latest legislative run. How does it affect his way of managing portfolio? Because he did say that he has changed his strategy in July 2021 from a risk parity all-weather portfolio to an economic inflationary regime portfolio. A lot of big words, so I let him to share with you, and I'm pretty excited to learn more from him. So welcome friend of the show, Freddy Lim from Stashaway. Okay, we back live together with Freddy, right? Freddy from Stashaway. For all of you that didn't know, he hasn't been out of the media circuit for a long time lah. So thanks for coming on the show, Freddy.
Hey Reggie, my pleasure. It's always enjoyable to be on your show. So I'm looking forward to some fun here.
For sure. Recently, a lot of things happening, right? So a lot of fun going on. I'm not sure if you can put it that way, but yeah, I think we are all going through some stuff, and also the markets are going through some stuff, right? So any opening comments, based on what is happening in the market at this current moment in time? You want to bring us through some thoughts?
Look, it's part of the market's natural behavior. You get the ups and downs, and you simply have to go back to your financial plans, right? And review your risk level of your portfolios, and don't get too excited always. It's all about planning.
Yes, and for all of you that don't know Freddy, I don't know how you don't know him lah. But anyway, for all of you that don't know him, right, he's a super big macroeconomic regime kind of investor, so very high level, and we're gonna have that discussion today. So if you have any specific question, I do know that for more retail investors, these parts can be a little bit more technical. Right, so a little bit more complicated economic factors and all that. So if you have any specific question, like we blabbering on, we're having fun ourselves, then you don't know what we're saying, right? You can drop in the comment section, and we'll try to, dig it out and talk a little bit more about it, right? So let's go straight in, right? Recently, there's been a lot of discussion, with the US-China. There are many factors going on, right? So China, today we are focusing on China, but China does not live in an isolated, world, right? So there are many other people in this world, and US-China trade war is probably the biggest factor so far that is not in the media circuit. It's very underdeveloped, in my view, of what is being discussed. Everybody's talking about Chinese regulation, and we can talk about that later. But opening this discussion, I want to dig a little bit deeper into the US-China trade dispute and how this whole thing is playing out in your view.
Well, to start with, it's still going on, and and
they say it's no longer a Trump thing. So yes,
yeah, it's still going on, and it's not US-China only. It's China versus the West, and it has a lot of implications, including the regulation measures we've seen of late. It's part of that overarching trade war, but it also leads to Chinese aspiration to be self-reliant in terms of technological needs, right? Chips, hardwares, robotics, even 5G networks. So the end story, to make it simple, is that the technological ecosystem of the future will be broken into two superpowers. It could be two ecosystems. All countries in the world will have to tread carefully between trying to service the two and not anger the other. because they are going to try to decouple and reduce their mutual reliance. And that this is leading to a lot of things that we're observing this year.
Okay, so hearing the first talking point is that you think that the technological ecosystem will be split into two, right? So it'll be a China versus the West. But I wanna dig a little bit about the West, right? So a lot of people talk about the West like it's monolithic also, but actually the US leads the West at this moment in time, yes, and probably more aligned will be Canada and Mexico. To be more exact, there's a block there. But the EU, it's a little bit questionable. So you want to help us understand why you think like this one whole thing is a block, and that the whole EU and Europe region still is leaning towards the US.
Well, if you look at demand and supply, it's sort of like China, US being the biggest in the room, and they're importing services, and they're also exporting services. But because they are the two biggest guys in the room, you can see the European Union as a bloc that's trying to service either one or both. So they are customers essentially, right? And you can see already the big network providers in Europe, they're trying to steer very carefully between US sanctions and also appeasing the Chinese. So they are pragmatic. They know where they stand. However, the US and China is more in direct conflict than any other country, right?
Okay, loosely, you think it's this two, and Europe is kind of in the middle, but it's more to the west in that sense. Okay, so then what do you think of like China's development with this whole like technological separation compared to just being with the US, right? Because okay, so the discussion is for a long time, the US has been the backbone of a lot of the big tech, whether it's a GPS, whether it's the internet, whether it's it chips and all that stuff, right? And China has been building on all those ecosystems, and to you, it's separating. And I think it's the discussion out there in the open that there will be a decoupling of the tech or decoupling of the markets, right? But how do you see this thing playing out in China? Like, how is it going to play out? Because it's not like we can just set up something immediately, So I want to hear a little bit on like how is it coming along? Maybe you will disagree. Think like China can do it very easy.
No, it's not easy. It's going to take some long-term commitments, but it presents investment opportunities for investors because somebody more backward than the US in a particular area is building this up. And the names in China is going to get government sponsorships, support, grants, maybe even blessings. So there are names that will come up, and you already see it even in clean energy reform. It's not a US thing only, even China. You see the likes of NIO, all these electric vehicles companies are really gaining momentum itself within China. So you have your Tesla equivalent in China in the future, right? That's kind of to be expected. So there are opportunities if you care to look, and if you do have a long-term view, there are massive opportunities out there. They are short-term noise right now, but I sort of I know the question is a bit long-term, so I will go to the short-term later. But it's a long-term strategic initiative that you need to take when it comes to China.
Okay, so you think in the long term it's gonna work out? China is gonna get itself sorted, and it's gonna become a significant player in the global stage, right? Is that the premise here that they're working on?
Maybe not global stage because they want to be self-reliant. So if I have semiconductors, I want to have my own national champions in it. So I reduce my reliance on importing from US and Taiwan, TSMC, for example, right? Strategically a problem. So I want to have national champions. I also want to have my own 5G networks to power all these innovations better, maybe even 6G. They're talking about 6G already. And chips making obviously is related. This very sort of input to other parts of the tech ecosystems, they want to sort of have more say in it. Internet stocks is one thing, e-commerce are one thing, but this is going deeper into the underlying hardware and network, the power of these things. So I think China is taking a very deep strategic look. The 5-year plan says it. The next 5-year plan will say it. The next 5-year plan will still say it.
Yes, definitely something to note. Okay, by the way, I just want to put it out there that 3G, 4G, 5G, 6G there are different technology altogether. Okay, it's not like an elevation of the same technology. it's just a branding exercise. But it's just being used too loosely. Okay, but anyway, China is leading in this whole connectivity 5G development at this point in time. So I get what you're saying, because the Chinese e-commerce ecosystem, or the consumer ecosystem, the digital consumer ecosystem, is probably a lot more ahead of other countries. It's very well developed. But the network and hardware infrastructure is a little bit questionable. So you can see that the Chinese government is trying to invest in it. So in the long term, I think they will, like you said, they will do fine. But you were talking about short-term noise, right? Like nowadays, there's a lot of news information going around, being very concerned about, China's regulation internally, China's initiative. What are they trying to do? Are they trying to kill their own companies? Do they not want to fight fight the US? Right? So can you kind of walk us through, like, how are you seeing all these regulations and all these quote unquote short-term noise?
I will go top down. And first, the ramifications of Donald Trump's trade war. One of them is the US now have this rule where the Chinese companies listed in the US, they must be open to supervision and audits. And then in those audits, they must be able to be demonstrating that they're not under any foreign government interference. And then they have the right data protection. And if they don't, they have a 3-year window to address it before the delisting happens. So that's on the US side. There's also the Chinese side thinking, oh my God, my national champions are listed in the US. The US can subpoena them for information that could be sensitive to Chinese national interest or security. So both sides have the same concerns. So the whole debate about China now is that, details aside, the recent regulations sort of surprised people. Because it surprised people negatively, they sort of like look forward to the next bad thing. What is the Armageddon scenario? Would China ban VIE, variable interest entity, which is a primary way for most China companies to actually list overseas? I will explain a bit more later. What if they ban it and then all the stocks get delisted, they become private and investors get stuck? And this Armageddon scenario and this kind of fear, because they were surprised by the education sector's measure, you naturally think about this risk. This risk is, however, misplaced, as I will get into the details later, Reggie, because, like you said, I'm not going to kill myself. I'm not stupid. So I want to put up a good fight. I want to just have a say about which companies should raise funds where. Maybe they should be in Hong Kong or some exchanges in China. We have enough capital in China. We're not lacking money, right? They want to have their say from the angle of national security, consumer data protection, right? Primarily. So this is the crux of it. Before we go into the details exactly about all those VIE and I'm happy to go into it. But the overarching thing is that most people do not know. In the last 20 years, most people invest in China, but under Chinese law, it's illegal. The Chinese law, most companies are not allowed to have foreign ownerships. And the VIE sort of is an offshore company approach in Cayman, and Alibaba used it, a lot of people used it, and they sort of made it happen. And the authorities turned a blind eye and allow it to happen for growth. All they're saying now is that, get my approval before you go ahead. I want to approve it. The moment they approve it, it becomes legit. For the first time ever in the history of Chinese financial market, then VIE has a legit status because now there's an approval process. All right. So that's all they're asking. Banning it is never on the agenda. It doesn't make sense. Right. So delisting because of the ban on VIE, because of Chinese policy directions, that is an Armageddon risk that's misplaced. So that's what I'm trying to put out here.
Yeah. Can you share with us a little bit why you think it does not make sense to ban it?
You think about it, right? How it works is this, right? Let's see how the VIE works. Actually, Alibaba did it. So they set up a paper company in Cayman. This is the VIE. The VIE had an arrangement with Alibaba at home that all economic interest and profit belongs to the VIE. Then the VIE goes to the US and work with the US bank and say, I want to list on NASDAQ or whatever as an American Depository Receipts, the ADR. So that's why, when you see Alibaba, the ADR has surprised And then in Hong Kong listing, they can do a secondary listing. There's another price, right? It's because of this reason. And however, this structure is in the eye of the law. It's never been approved. They turn a blind eye. It's never been said it's illegal, but it's not legalized either, right? This is tricky catch-22 when investing in China. Now, when China says any new company want to list overseas or any existing company who's not affected anymore, but if you want to raise additional funds, you come to me for pre-approval. I want to be the one to decide whether you can raise in the US or you should come home. It should be in Hong Kong or somewhere. But you need approval. And the approval will look at things like, are you your data security, cybersecurity, national interest, and so on. So the case of Didi was the most outrageous because they actually couldn't stop Didi from going public, but they want Didi not to go public. So you see, they can't even ban it. It's out of the jurisdiction. It's in the Cayman. So this is misplaced because they cannot ban it. But what they told Didi was, don't go ahead. You still have issues to iron out before you go there. Didi went ahead anyway and able to go ahead. And what's worse, in the same week of the 100th anniversary year of the Chinese Communist Party, what do you expect will happen? So they banned them from the App Store and all that retaliation, right? So
you think that is a political thing?
No, that's a corporate bad behavior being punished. It's not even politics.
Okay.
Yeah, that's what I'm trying to say. It's totally disrespectful. Regulators have told you, because it's consultative, they told you do not go ahead. You went ahead, and there's a 100-year anniversary of CCP. So this is outrageous. Immediately after Didi, it triggered this cram down the education sectors, which for years got a lot of complaints. Parents are stretched with their budget and spending. Kids are stretched for time, never had any social life. It's becoming a social problem when private capital, a massive amount of private capital is in the social goods. So they're actually trying to address this, right? But the issue is not the policy, it's just it's a PR or communication issue, because it's sort of like directives are set here. Every department wants to show that they're doing something and started implementing policies and notices. And then it seems like a sweeping reform that was unintended. And then the market will be the signal that the top will look at and go, okay, hang on a minute. Something is wrong here. We need to do this better. So this is what's happening right now. China is consulting with the banks. Even China is consulting with the US since the SEC say, I don't want any Chinese companies to list anymore in the US because of unclear policy implementations. So it's good to see them talking because they care. And lastly, one more good news is that they're going to do fiscal stimulus again to try to buffer the economy. So all this are coming in. So they do care. The national team will come in, the stimulus will come in. The policy may try to find a way to implement better. But they are reacting to issues that's been raised by consumers for many years.
Okay, so in your view, two things, right? One thing is the Chinese government is merely just reacting to what the ground wants, okay? And the other is that the VIE structure is in some ways in the process of being legitimized, right? So it's not gonna like disappear, right? It's here. It's in fact, in this whole saga, it shows that it's here to stay.
Absolutely. That's exactly the crux I'm trying to say.
Okay. Pretty interesting. But then, so what is the kind of short-term reaction in the market? Like, how do you read it? Of course, I know there's a lot of fear and all the noise and all those things, right? But how will you feedback to the listeners of like, what is this whole short-term view of things? Like, why are people, in your words, very short-termism?
Well, first of all, the game spoiler was monetary stimulus, right? In the history of money, in the last 100 years, most of the money is printed in the last 1 year because of the pandemic. And we get spoiled because returns were very high last 1 year. And the fact that to try to get people to buy dips is becoming a very psychologically a different thing, because people are looking at all kinds of very inflated assets and they're chasing returns. However, when you ask people, you interview them without the noise and social media on, they will tell you they want to buy low, sell high. But the actual act turns out to be buy high, hoping to sell higher. That eventually could be a problem when, you know, that in a bull market, it's very common to see a correction of up to 20% it comes randomly, nobody can predict, and then it just bounces back very quickly. This is the way the market detox and takes out bad players so that it can move forward healthier. So that is one of the things that will come, is inevitable. And what I'm trying to say is sometimes something with very strong long-term potential, in the near term, there's some headwind, you got to think forward. So it's sort of like, what do I mean by forward looking, right? In summary, translation, what's next? So you think about what's the next bad thing that can happen, evaluate its consequence. You think about the next good thing that can happen, evaluate its consequence. If the ratio between the good versus the bad is a very high one, that's a great long-term investment. And most likely in this case for China is the next good thing is taking medium to long term, and it's a huge one. The next bad thing is very short term, but its impact on the market is now getting smaller and smaller. You can tell that from the price action. So the ratio is shifting in favor of the long-term investors soon. So that's how I think about it. It's very complex. It may sound complex, but this is the way the market function is forward-looking. That's what we meant by forward-looking. It means what's next? What's the next bad thing in the near term? What's the next good thing in the medium and long term? What's the ratio between the two? And then can I invest in the long term? This is how it works. More translation, Reggie, bear with me. Think about the market as a room with 100 people. If everybody has bought, who's left? If everybody has sold because of a development on the news, whatever that is, but everybody in the room knows. And so, what's the problem? Right? What's the problem buying now? All right. So this is also a forward-looking setting. It's more game theory sort of setting, but it's also forward-looking. So I think in this, I'm just trying to tell audience how, as investors, professional investors in the industry, how we typically evaluate scenarios, or we actually look at numbers, but it has to be what's next, what's the next good, what's the next bad, what's the ratio.
Okay, that's cool. And I know you do the whole like asset allocation strategy, with all your macro factors, and you kind of look at the broad market, right? So main question is, have you changed your composite in any ways as a result of all this development over the past half a year? No. Okay, great. Important, right? Because that's the whole long-term, the whole idea of having that kind of long-term allocation.
We completely ignore in the markets. We are focused on leading economic indices on growth, on inflation, on interest rates, things that ultimately drive returns, crazy up or down in the medium and long term. We focus on those big factors. That's how the central bank work as well, as you know. They look at growth versus inflation. It's a tug of war between the two. We call inflation adjusted growth or real growth. That is the ultimate driver. We focus on it too. And the market sort of event or rumors or policy changes, the effects don't last forever. What lasts forever are the economic cycles. Yeah. So summary, actually we don't.
With that idea in mind, right, how are you allocating your capital then, in the broad scheme of the whole world and all that jazz, right? For people that are listening, whether they're Stashaway user or not, I think people will be pretty interested to know how are you envisioning the broad world and how are you allocating your capital along this whole, the world?
Well, it's a great question. First of all, I don't decide it. The machinery that we have built and stress tested and actual experience over the last 4 years, it systematically applies it. And as you know, the last 4 years, we have 2 market correction in 2018's trade war, a pandemic last year, and a China rout right now. And the
it's been a crazy few years. So yes, I feel you.
And I want to also FYI, our return ranges per year from 3.8% in Sing terms for the lowest risk to around 16.8 per annum over the last 4 years. But it's not by being faster and to react to something. It's by being more systematic and consistent. So what is this systematic approach? Is your question to me now. First step, we look at slices of the historical data that correspond to the upcoming economic cycle. We dissect leading economic indicators, like I said, to try to gauge where the economy is. And then we slice the history for the parts that's most relevant to it. Otherwise, you have this long-term data thing that has a lot of noises and garbages. So you need to find the most relevant slices of data as a starting point. Then, as a second point, we look at valuations of each asset classes that we tracked. There's a lot, couple hundreds, and we choose only some for you because the algorithm will choose from a big universe. That universe is a lot of asset classes, and each asset class is valued against growth, inflation, and many other macroeconomic factors. And in particular, we try to see where are the most overvalued places. Be careful. It's a signal of FOMO, right? Fear of missing out, overcrowded investing situation. You want to be mindful. The risks are higher there. You need to raise it. You need to lower your expected return. Vice versa, on the other side, things that nobody likes today, that underappreciates it. We, as long-term investors, we want to start building it up. We're, after all, DCA investors. We will take time to build it up. I'll give you a good example on this one is gold. We've been buying it since December 2017, when it was 1242, when we first bought it in a real meaningful way. And then during the pandemic, to provide protection against inflation and dilution of paper money because so much money is printed, we also fine-tuned our gold allocations. Very long-term view. We did it since 1240. We didn't care whether it's 2000 and came back to 1800 because it's about portfolio insurance. But the valuation was very depressed. The second thing I told you, the valuation gap was so low versus economic fundamentals that we added on the assets, right? It's been 4 years. So that's how it works. Third one is sort of a situation called fail-safe one, managing uncertainty. When there's too much uncertainty and the economic numbers, leading numbers, analytics, momentum, anything doesn't tell you where the economy is going. You simply do not know for now. We go into an all-weather strategy, splitting money across all possible economic scenarios equally to preserve good risk-adjusted performance rather than take a view. So that is the all-weather strategy that we were on last year, right? And so that's a third pillar for our system. So it's a very systematic process. A lot of things going on there. No single human being can say, I feel good here, I feel bad here. This is the allocation. And not just one portfolio, but for many people's portfolio, it's impossible to do so.
Fair. So are you still holding on to the all-weather strategy at this point in time?
Well, we have gotten out of that towards a inflationary growth regime in the US. So inflation momentum has really picked up. It's 5.4% for the US right now. It was barely even 2% a couple of months ago. And the momentum there is strong. And we sort of identified that the COVID situation has created a lot of disruptions to supply chain. Hence, you can see base metals, commodities like food prices as well, all going up because of this. And it would take quite a few years for industry to adjust unless the vaccination drive is able to reopen borders. We don't know how long that's going to take. Even though it's not a permanent for everything, but a couple of years is enough to raise eyebrow, and we want to protect the purchasing power for our users' portfolio. So we re-optimized this portfolio on 21st and 22nd July, this last month, to sort of better prepare our users for this very peculiar environment.
Yes. Okay. So I know. By right, today we're going to talk about China, right? But since we're at this inflationary topic, I think this is also an important thing that we want to discuss. So I want to find out a little bit more about the whole inflationary growth regime. How is this different from the disaster case of a runaway inflation? How are you looking at it? Help me understand this, because a lot of big, high level terms. I definitely want to get into your head on this.
Inflationary growth is very interesting because you still got good amount of growth and rebound the real economy to run on. But the problem is some pockets of the economy, some countries are running hotter. So US is importing a lot of inflation, whereas emerging market actually no. They are the one exporting the inflation. They're gaining from it. So they are winners and losers. So it creates a lot of opportunities for a globally very diversified portfolio to seize on. That's what we're trying to do. So US may confront the problem, but the global ex-US economy is actually less so. China inflation is very low. Even emerging markets are pretty tamed. They are the one exporting it. so, so that means Australian equities could be interesting. Some emerging market bonds could be interesting. Some global ex-US inflation-linked bonds are also very interesting. Natural resources, REITs as well. So there's a lot of opportunities as the economy starts to rebound, right? I also want to say the last time we have a very sustained long period of inflationary growth was like at least 34 years ago in the 80s. So most fund managers have not seen it. If they've seen it, they probably retired. And so the only thing to guide us is data, right? And the fund manager track record may be less relevant than before because they never lived through it, right? However, we believe that if a well-founded economic principles driven allocation machinery, it should, from the data that we see, create some sort of a buffer.
Yeah.
But human experience could be very biased towards what you know, right?
Can you help me understand a little bit more what do you mean by US is importing inflation? Like, does it mean that generally the consumer price index in the US is going to go through an inflationary cycle? It's going to be a lot higher. It's going to grow a lot higher. So then, based on what you're saying, if that's the case, are we trying to avoid, putting too much money in the US, or what is the gameplay?
No. Not necessary, but you're right in that you're importing because food prices went up, base metals went up, because sometimes weather, sometimes COVID disruption to supply chain, right? You may say it's just a few years, it's not permanent, nothing to be alarmed, but it's real in the meantime for a few years. So then the implication is that it's not bad for equities. It's just that if you're not prepared for it, your real purchasing power from your equity return goes down. If you buy bonds and at a very low yield, then you also get the fixed income return gets eroded even further. So what it means is you are forcing investors to be more and more concentrated in the US stocks. So that's one of the problems. And they need to start looking globally. They need to look away because US is the first one to rise. Emerging market has not really rotated yet, but could be the next one. So people need to start diversifying globally more. But what I'm seeing right now is a lot of build up in exposure because the market that goes up the most attracted the largest number of money. China's recent route also got a lot of money back to US, buying those things on the high, right? At some point, this set up for a correction, then it could be quite a bust. For us, we look forward, like I said, what's next? And you need to start thinking beyond just the US. And so you're right, the inflationary growth thing means whatever return you get from US stocks, for example, is going to get diluted more by inflation, whereas globally, the return from other places are unlikely to be diluted because they don't have this inflation story yet, quite far from the US. So opportunity could be elsewhere.
Okay, that's a golden nugget. Opportunity could be elsewhere. So back into China's market and the discussion on China, right? So I think a lot of people are exploring, definitely investing in China. I mean, so far the discussion here within our community or even in the local environment is not so negative, towards China. People are concerned, people are fearful for sure, but people are generally opportunistic and positive about China, lah, essentially, right? So when I look through your fund selection, I know you have a whole algorithm that you've built to decide, and you've briefly shared all those stuff. But within the funds, you predominantly have two main funds that has exposure to China. One is the Chinese tech, China emerging tech, and the other one is Asia ex Japan, MSCI all country, right? So can you kind of walk us through these two funds? I know the algorithms do most of the work, But you as a person, you also be like, why these two, right? So for us that don't have access to algorithms, I'm curious, like why these two funds?
Well, we first started with AAXJ, which is the Asia ex Japan piece you mentioned. And by now, it has about around 38% of allocation in China and around maybe 13% in South Korea,
And it increased,
4.5%
right?
Malaysia.
China exposure increased over time.
Increased and came back down because of recent. It used to be 41, now it's like back to 38. So it does actually change because of performance. But up until end of last year, it went as high as 41. I think right now it's about 38. Don't hold me to it. It's just off the cups,
It's okay.
mental
Yes,
calculation. Yeah, but
yes,
roughly
yes.
there. It's a broad-based exposure to China, so to buy everything under the sun approach. Whereas the KWEB, the Crane Shares China Innovations Fund, is more focused on e-commerce, internet, software, and the likes. Now, the algorithm chooses from the universe that we set up for them. But over time, the investment committee at Stashaway would always be on the lookout for other funds. We even have backup funds in case this fund has some issues, we want to replace it. We also have regulatory requirements. Some of the funds fail below those requirements. We need to replace it, right? So actually the universe is huge in the back end. So if Crane Shares, for example, if you worry about delisting, and Crane Shares has 40 shares out of 53 ADR, but they have the ability to buy onshore. There's nothing to stop them. But if they are not doing it, we will be doing it for you by changing the funds, right? So there's nothing to stop KWEB, for example, from redefining the index and directly invest in Hong Kong listed names or Shenzhen listed names. They're buying ADR, it's a legacy thing, but there's nothing to stop them from changing. And a lot of names have secondary listing, is easy to replace. Some names may not have, so you simply have to just change the composition to something else. That's an easy thing to do. If they're not doing that, they wouldn't survive either. They have to do it because if they don't do it, I will be doing it, right? So it's sort of a constant evaluation. The fund's cash flow, the fund's use of derivatives, the fund's deviation from benchmark, and even the tracking error in good market and bad market. We try to we dissect a lot of this into, and over time we may change the list from time to time. And then the algorithm will take the new list and work its magic. But we still define the universe, right? So at the moment, we always want to look out for more exposure to different parts of China. But sometimes you say, hey, why not have a semiconductor one, Chinese only? There's no liquidity. Or how about electric vehicle? It's very concentrated, is not a lot of liquidity. But however, funds start redefining indices, names start coming in, we will monitor those things, and then we will include some funds as more diversified, right? So it's sort of like some people may say, hey, even though Freddy, you mentioned about hardware, 5G networks, you're still a lot more into either the traditional or all the way to the softwares. And but that's because of a liquidity constraint. We want to make sure when users need money, they want to withdraw, they get to be able to sell a portion very easily without paying too much. So we have that buffer. Some parts of China will take time to be more accessible. That's what we mean. However, they are changing very fast, and we are on the lookout for more funds in the mix. So don't be surprised. We may even further fine-tune the China exposure, break it even deeper. Not because we are changing our view. It's up to the algorithm, but you're trying to broaden it, right? Deepen your riches as and when the liquidity in the market allows, right?
Can you kind of give me a little bit of idea, like what is considered a highly liquid fund and what is considered an illiquid fund in your view?
We look at relative ranking, liquidity ranking relative to peers. So Bloomberg published a score, it's called the LQA score. Bloomberg LQA score is effectively saying, for what this fund does in the same category of all the funds in the world, what percentile ranking you are. And just so you know, by the way, on average, Stashaway's global flagship portfolio, ETFs in that component has an average score of 98.5 to 99 percentile in terms of liquidity. Like I mean, you can't get better than that. And then our sort of 50% Sharia compliant portfolio in Malaysia is 50 global, 50 Sharia, also has around 97. It ranged from 96 to 97. So it's super liquid. So we are trying to keep that in mind when we construct a portfolio. You can't just look at daily volume because ETF changing hands doesn't reflect the full volume. The underlying names that the ETFs are tracking has its own volume, and it can trade off exchange, off market. You can't see them on screen, right? So we look at a lot of these metrics, and we want to make sure we get the best liquidity and the best diversification. That's really key.
Okay, that's good. That's good. And I think you definitely sound positive about China long term into the future. Kind of walk me through a little bit of like, are you intentionally trying to increase your exposure to China in terms of your allocation? Like, are you trying to have a higher percentage in China specifically? Because the broad MSCI World Index is hovering about 7%. Exposure to
I'll give you
China.
two reasons. Sorry, I jumped ahead. Two reasons for you.
Yeah.
One is the inflationary growth is actually good for asset class like China because they tend to, if you look at their empirical data, their sensitivity to this, they gain from it, especially tech names. They even have a higher sensitivity to inflation trends. Two, valuation. Because of the fact of the near-term headwinds is finally giving you an opportunity to buy a great potential in the long term on the cheap today. And as DCA investors, this is fantastic. If you're the billionaire and you invest all your whole billion today, right away lump sum, maybe not, because it's going to be volatile. You may be annoyed in the near term. But for most of us savers, we have a job, we have monthly income, with less spending, we saved, we invest those savings beyond our rainy day fund. When we average in every time, this is a golden opportunity for you to build your portfolio for a long-term, very great long-term potential. You can't always buy the high, like I say, and you also you don't have your whole billion right now. You are building it up and don't know when you retire there, assuming you get there, and it's sort of like, why are you caring about short-term return? Because unless 100% of your net worth or your total lifetime earnings being invested, then of course you're more sensitive, and you may think like a trader. But when you are building your savings nest every single month for the next 10, 20, 30, 40 years, what's the problem? This is great. Alibaba, Tencent is not going to go away. The synergy between WePay, WeChat, and all kinds of other things that are cross-selling is massive. The marketplace from Alibaba is insane. I mean, where else do you get such companies that's going to grow with China? They just need to be put in the right place right now for the social good. And then they will be very heart of Chinese expansion plan, right? Right now, they need to be put in the right places. That's what we are seeing. Hence the opportunity, but you don't like to buy now, you will never get in you always be buying the high. So are you investing or are you trading? So that's the ultimate end question for ourselves.
Fair. Okay, so I want to ask also about hardware, right? Hardware in Chinese hardware tech. Like you said, maybe it's not so liquid, but you're probably observing some funds. And I know when I say this, you always say, why you never open Stashaway account? But anyway, so not everybody is a Stashaway user.
No, I've never say that. Don't feel obliged. But if you do, I'll give you a VIP discount code.
Okay, thank
when
you.
you do. Don't feel bad about it.
Yes. But I think the idea here is I want to get VIP access to your brains of like, what are some of the funds that you're looking at that will give us a bit more exposure, although they may be not so liquid now, but you are observing them, in the Chinese hardware space.
Well, BlackRock, the iShares have some Hong Kong listing. The dollar denominated one is 9067 HK. That's a ticker. I think that's a Hong Kong dollar denomination as well. Maybe it's 3067. I'm not sure exactly, but it's hard to remember the numbers.
Yes.
But the liquidity ranking is around 89 percentile. It's not 99, 98, or even 95. So we are monitoring. Stashaway has not invested in it yet, but I'm saying it sort of like from a third party perspective.
Yeah.
Then the CSOP, or this local asset management firm, has quite a few ETFs that track the Hang Seng Tech indices. There's also iShares China ETF that's broader based. You have a combination of brick and mortar and internet names. So if you prefer that approach, that works well too. So, however, liquidity profile is nowhere near where I wanted to be yet.
Yes.
Yeah.
Okay, so Hang Seng stuff I shares, huh? So I managed to dig something out for all of you, huh? So, but okay, so I think there's one question that comes up in the community quite a lot. It's like, why should I pay a premium for like SG denominated stuff? Like why can't I just it's management fee is a bit higher if I want to have like SG denominated. Why don't I just buy US denominated or just buy Hong Kong denominated? They tend to be a bit cheaper wherever they come from. Essentially there's some sort of hedging. In this whole
Well, I wonder
process,
that
right?
too a lot, by the way. And as you know, Stashaway goes global. For example, our 50 Sharia 50 global portfolio in Malaysia is actually trading in London. And then our global flagship is US exchanges. The Singapore exchanges, I think it's justified in a case of funds that actually hedge all cash flow and return in the US into Sing dollars. That costs money to maintain, hence the management fee could be a bit higher. However, only a professional can work out what's the right fair amount of spread. So I know what I expect. And if they go beyond a number, then I know they're charging too much. But however, in most cases, Sing denomination doesn't mean you're hedged. It's just that they offer a Sing dollar class of the same thing, like gold traded in USD. They also have State Street also has a gold equivalent in Sing dollar denomination. There's no difference really because no hedging is going on, right? And so I wonder why, if there's higher fees there, why people would do it. So that I always am puzzled myself. Maybe it's my lack of financial knowledge, but I struggle too.
Okay, fair. Good point. So essentially, it's a lot more complicated as to why people are doing it, and but there's also a little bit of discussion in the retail space that says that if you're in SG, you don't need to be too concerned about RMB's fluctuation or RMB's forex because the SG government, which essentially MAS, is tracking it very tightly, and they are doing a lot of things to with the basket of currencies and all that to ensure that the Sing dollar is collaborating and working along the renminbi. So in that sense,
It's a fair point.
What are your thoughts?
It's a very good point because the Chinese side is also on a managed band,
Yes.
very tight. And then the Singapore side is also on a managed band, so you got double management. Whereas when you're doing against USD, Sing against US or Yuan against US, is one side doing it. Sometimes they let it drift because they couldn't hold it anymore, right? But when both sides doing it, your chances of a stable currency for longer is very high. So that's actually is a very valid point on this. It's a fair point.
So in other words, maybe you don't need to pay a premium for SG hedging or SG denominated.
No, but my point is still, you need to go to the FX forward market to work out what is we call the term structure or FX forward, meaning if you hedge your cash flow 1 year and down the line, why is the market naturally charging you? Because interest rate differential will give you, it's sort of like will cost you 0.5% to swap cash flow from dollar back to Sing, let's say, for example. So if you fully hedge your return next 1 year, whatever you get in the US must be less 0.5%, right? Let's say. So that's the meaning of the pure market cost. However, it's not as transparent to say the fund's charging, like the fund expense ratio when it's not hedged versus hedged, the difference, then you got to compare against FX forward market. I don't know how many people have this info. I have, but I don't know how many people out there actually have such clarity, right? To evaluate whether it's fair. Yeah.
Okay, fair. So let me try to speak that in layman's term. Essentially, The normal fund that is denominated in US is not brought back to SGD currency, has a certain expense ratio. If it creates another fund that is SG denominated, it will usually add a certain expense on top of the base expense ratio that it charges, right? So essentially, it's charging us a little bit more to do that work of turning back to the base currency that we operate in here. Okay, so with this premium, you want to make sure that it's not a lot higher than the kind of fluctuation in the exchange rates between the base currency of USD to SGD. So if the fluctuation here is about 0.5%, then it shouldn't be more than that in the expense ratio. Is that kind of what I'm hearing?
Not fluctuation, but more like today the market tells you there's a price. If you want to hedge, insure your cash flow, the market participant, the pricing is like, you want to hedge 1 year forward in the future, that cash flow, want to bring it back to sync, the cost is 0.5% less, hypothetically. That's a market price for that. And you lock it in. You can lock it in today. But then if the fund manager incur more than half a percent, meaning the expense ratio for unhedged and then hedged, that spread is more than 0.5 in this case, that means that it's a bit is higher than what the market is charging, right?
Okay.
So then it may be not very good for investors.
And it's actually okay to let it float also, if you have a more complicated portfolio and what have you. Right? I mean, we talked about this the other time. Sometimes you can use this to your advantage. It's not always about hedging everything and everything has to be in control. Right. So the basic idea is 50% base currency, 50% foreign currency, and then you're kind of already balanced out. Right? I remember this lesson. Yeah.
You have a good memory.
Yeah, of course, important, right? We're in the space, so yeah. So I think we've covered a lot from China's relationship with the US going forward and China's internal regulation, all the way down to different funds that you're looking at, how to play the game, or how to allocate your resources or allocate your portfolio to be exact. So yeah, is there any last things you want to add for us? Specific to this whole China future and China investments, and how do you look at this thing?
Well, I think maybe more like a reminder as something that I said earlier, which is you got to think forward. News, noisy, and so on. We're bombarded by traditional and social media now. The more we need to stay on top of things where more news or more data more noise doesn't mean more insights.
Yeah, more tautia.
More tautia, yeah.
Yes.
More aspirin you need to take, and so you need to ask yourself, the whole world knows this or not, right? And then what's the next bad thing? What's the next good thing? What's the ratio between the two? Then you know whether it's a good investment or not in the long term, right? I just want to re-emphasize that. And also on closing, beyond that, is ultimately the majority of your success is actually not about the market. It's really the financial plan. Like, I think, Reggie, you can memorize this now, but I'm going to give it to you. Before you invest a single dime, have your rainy day fund. Your personal circumstances will dictate what is the right amount. Once you have a rainy day fund, then you can start investing. Then you can average in, build a portfolio. Then the next step is, what's the right risk level for you? Meditate on it. Is a 20% extreme scenario drop something you can handle? If you can't, bring down the risk. It's not about I like China or I like US tech or none about that. It's ultimately about all the speed bumps, whether you are able to handle the speed bumps. Budget that in, plan it in, and then just stick to your plan ultimately. And that was it. There's no market timing, there's no views, or there's no professional opinions. You don't need that. You already have a diversified portfolio. You run along with it.
Yeah. For all of you that are listening, specifically for the risk factors, for a long time I also don't know what it's trying to tell me. Okay, but by the way, just reinforcing what Freddy is saying. Essentially, if it's a 20% risk factor, that means in the extreme case, it is expected to drop 20%. Or in an extreme case, it's expected to drop 38% if the risk factor is 38. right? So if you beta 138% drop, then you can take a lower risk profile. Essentially, that's what I'm trying to say. Okay, yeah, because that's at first I was like, what is this risk profile? How to look at it? But yeah, so thanks for joining us today. I think we've talked about a lot of high level discussions, all the way down to the gameplay and strategy. So thanks for expounding a lot of your thoughts for us. For everyone that is tuning in, if you have any questions you want to continue to have, come to our Telegram group, head over to thefinancialcoconut.com to sign up for our weekly newsletter, and sign up for Stashaway. I will I'll try to get promo code. Let's discuss again. Yeah, and we gotta catch up for
Sure.
coffee, right? So
Sure.
yes, take care, guys. See ya. Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. We are doing a weekly newsletter reboot. We're going to have a lot of information within the newsletter. Everything is in the description below. And if you love us and want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have any interesting thoughts you want to share, or you know someone that we would like to hear from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week, and always remember, personal finance can be chill, clear, and sustainable for all. Hey coconuts, it's real fun hosting these guys on our lives, and I hear you that many of you guys prefer the whole audio, because I'm a big fan of podcast consumption, to be honest. I prefer everything on audio. I can be traveling on MRT, and I can be doing the gym, doing my chores and what have you, and just continue to enjoy and learn new things. So big fan of podcasting, but we're hosting a lot of these live events so that we can stay relevant and also give you a platform to ask questions. So if you have any specific questions that you want to ask about various topics, please join our live sessions to participate and bring your questions out, and you will be answered. So that's the fun part. We actually answer a lot of the questions, and I want you to be there. So yeah, join us. If not, continue to enjoy the podcast. Yeah, I appreciate you. But do sign up for our weekly newsletter and sign up for our other podcast. It helps us grow, helps us have more negotiation power with advertisers, and also continue to provide us motivation to keep creating good content for you. So meanwhile, take care, stay healthy.